Go ahead.
All right, I'll just give you all kind of a quick synopsis of what I'm hoping to go through today. We'll kind of go over the basics. There's a few kind of fundamental things in tax. That's the fun stuff that apply to Bitcoin and kind of crypto in general. So yeah, we'll go over that, and then we'll talk about some of the different ways that you might dispose of or obtain, and how that affects the tax, and then some of the other little things Lee and I kind of spoke some general questions that I'll go over, and then I'll open it up to the group and find that's usually the best way to. Most people have pretty specific questions, and I can try and answer those the best I can. So yeah, the biggest basic of Bitcoin is it's taxed as a commodity. So what that means is the tax treatment really is tied into kind of the underlying nature of what it is. So if if it's purchased as kind of a long-term investment, well, then that's something we kind of consider capital, and it would get capital gains treatment generally. On the other side, if it's something it's used in business, well, then it's a little bit of a different situation there, and it's treated kind of as business income. So that's kind of a fundamental taxing. I won't go into details of that, but the big difference between those two is, like most of you I'm sure know, capital gains are treated at they're taxed at 50%. It's included in your income, whereas business income is just the full amounts included in your income and taxed at whatever your marginal rates are. So a few kind of situations where we'd see the difference in those is, if I just buy Bitcoin, it goes up in value, I sell it, that's capital gain. Now, if I receive Bitcoin because I'm running a business and I'm selling a service for that, well, that's actually business income. Then you get into the combination of both, where if I'm getting Bitcoin as a payment for something, well, that's my business income. And then if it goes up in value and I sell it, well, we got to kind of look at that. That event there might be a little bit different because, you know, one of the things that I don't know if many of you ever dealt with, but day trading becomes a business. Well, you're dealing with securities. It's kind of a similar concept to, say day trading Bitcoin. If you're buying and selling, well, are you operating a business? That's a whole different another question that involves quite a bit of little research. There's a bunch of different things that factor into that. I won't really get into that, but the CRA has some really good references if you do go online and Google, business versus capital income, and they'll go through a couple of factors that considered. Every case is different. So that's the kind of one main thing to consider is really, if you're running a business by buying, selling, all that kind of stuff, and you're doing tons of transactions, you're putting a lot of effort in, well, then you probably are going to slide onto business income versus capital. There's a fine line between the two. It's never concrete. So that's real something to consider, and you'd probably have to evaluate on your own, or I'd recommend in that case talk to an accountant, because since there's such significant differences in the tax there, if you're losing lots of money, CRA always kind of, they look at that, and if you have a big business loss, well, those questioned more often than not, versus when you have capital losses or capital gains, those are taxed half. So if you have huge capital gains, you're doing lots of trades, buying and selling, it it can kind of have a different effect and different flags on both sides. So that's kind of the fundamental of what Bitcoin really is from a tax perspective, and how the CRA looks at that. Now, I mean, it's all pretty new, so this might change. They don't see it as a currency. Um, so it is kind of treated as this commodity where you, oh, that's an interesting question, Stephen. I'll get to the questions kind of afterwards. I'll go through my little spiel, and then I'll try and answer all those the best I can. So something else that we have with Bitcoin is that they are considered identical properties. So if you have one, you have two, you have zero point 0.5, they're all kind of considered the same in the same lump. So when you buy and sell these, well, if you buy one and then sell one, it's usually pretty straightforward with that simple transaction. But if you keep buying it at different prices, that starts to have an effect on the cost. So it's important to keep in mind that they're not, we don't kind of treat them as different items. They basically all get lumped into one pool. And when you sell it, and I'll talk about that in a second, you're kind of pulling out of that same pool, and they're not really considered different. So once again, if you ever have questions about what kind of are identical properties, just Google CRA identical properties. There's a good document there, some great reading. But just know that. they're all considered the same. They're not different. Um, if you got into some of the different kind of things, I know with NFTs, those would be those are distinct properties, but I won't get into that. As far as Bitcoin goes, 1 or 100, they're all kind of considered the same pool. So yeah, so kind of the next step is, how do I track all that? How do I do this? So if you're buying and selling, you buy one, you sell one, that's nice and easy. If you we I'll assume that we're talking about capital gains here, because the business use and all that kind of stuff, that's kind of a separate story. But if I buy one for $100, I sell it for 200, I've got a capital gain of $100 there. Like I said, half that's included in income. You'd pay tax on $50. Now it starts to get a little bit more complicated. You buy one at $100, you buy one at $200, you buy one at $300. Well, now I've got 3 Bitcoin. I paid $600. Well, the way the government looks at that is, I've got 3 Bitcoin, paid $600. Each one would have a cost of $200. So if I sell one, I don't pick which one I sell. I don't change the cost. I basically sell one for $200. And if I sold it for $200, I've got no gain or loss, because that was the cost of each individual, or each Bitcoin, because it's all becomes part of a pool, which we'd call a cost base there. So, and so I see a question there about borrowing against your Bitcoin. I'll touch on that. That's another topic there. So one of the things about kind of the buying and selling and the average cost base is it's really important to track your transactions. That is something that is kind of a bit of a nightmare thing to do, but it's really important, because each transaction or each buy is really going to likely change the cost base of your pool Bitcoin. And so you're going to need to go kind of transaction by transaction and make sure you're keeping a record. There's lots of great sites out there that'll do it for you. I won't go into them. I personally use Excel. It's my favorite way to do that. I'm an accountant though, so I'm pretty familiar with that, but I know there's lots of services out there. I think Coin Tracker is one. I'm not sure, I haven't used them, but you can find ways that will let you enter your transactions, or some of them might pull the APIs and do all that for you. But they'll kind of keep an eye on your transactions, track that cost base, and that's what you're doing, is basically tracking how much money you've put into this pool, dividing it by the total amount, and then that's what your average cost per Bitcoin would be. And then when you dispose of it, you want to pull that average cost out of that pool and do that. So kind of going back to, there's a few ways that we might acquire them. We've been talking about buying, but so actually, quick question, I'll answer that. Can you FIFO them? No, they're considered identical properties. They're all going to go in, and it's going to be average cost base. So basically, you're no choice on which one you're selling. You're selling from the pool. So that's what I was kind of getting there. So different kind of ways that you get them. Buying them, obvious, that one's pretty simple. You'll know what your cost is. If you mine Bitcoin, well, you're going to have, that's considered business income. So what happens there is, you should actually be reporting that as business income on your tax return. If you're doing it personally, then it would be on the 2125 schedule, as you essentially be a sole proprietor. And what you're doing is, that's business income, and the Bitcoin that you're mining is actually just inventory. So what would happen there is, your costs, whatever, electricity, all that kind of stuff that you'd be doing to generate that would be your expenses. And then you'd offset that by the income you earn. And to determine how much that is, you'd really just want to take whatever the market value of Bitcoin is at that time when you receive it. So, there's a few ways you can do that. You can take an average of the day. You could try and find the time that you received it and take that price. Because it's so volatile, I would probably go daily average is something that I would probably say is a reasonable way to look at it. Because this is so new, and I'm sure the government's still figuring out the best approach to audit this. I think if you give it a good shot and show at least you gave a little bit of effort, they'll be fine with that, unless you're pulling something out of thin air. So my recommendation would be find when you received it that day, take the average price over that day, and you'll probably be good. That would be business income, and you'd offset it with whatever expenses that you did incur in order to mine that Bitcoin. Something to kind of consider with all that is, you use electricity, you use computers to do all that. You can't claim personal expenses generally all that stuff. So you'd want to make sure that you're including expenses that relate to that, because that's something that would be, if they ever do look at, it's a consideration that the government always kind of looks at, that when you're running your own business, you've got personal expenses like electricity, a computer that you might use for your own time, all that kind of stuff. Once again, if you are mining, I'd probably recommend you go talk to an accountant about that, or at least do your research on the whole business side of how that's taxed, or how you report your taxes. As far as Bitcoin goes, you just report the fair market value as your income when you receive it, and then offset it with your expenses. So another way you might get it, if a friend gives it to you, get it for free. So in those cases, you wouldn't have any cost. Your cost would essentially be zero. Your friend's giving it to you for free, you'd think. But what happens is they're going to pay tax up to the fair market value on that date. And whenever you have transactions between related parties, so friends or people who are not a third party sale, so I'm not trying to get my best interest, and that usually happens when someone gives you something for free. What actually happens is the transaction will occur at fair market value, and they should report capital gains or whatever tax and dispose of it at whatever that value is on that day. So, I mean, take the average value for that day, or if you want to go right down to the time, you could do that. And then your cost would actually be the fair market value on that day. So what would happen there is you're going to pay capital gains on the difference between when you receive it and when you sell it. They're going to pay capital gains on the difference between when they bought it and or earned it, and then when they gave it to you. So unfortunately, that is a taxable event for them. Something to kind of know. Okay, that Mount Gox one, I'll get to that one a little bit later. Similar to if you win it in a contest, that would be a little bit of a unique situation. I would record it at fair market value when it's received, and then you'd pay gains on the increase. So if you got 0.1 Bitcoin, you'd have your cost will be whatever the fair market value was on the day you received it, and then that change in value is what you'd pay tax on. One of the things I've seen a lot lately is seems to be gaining a lot of popularity is the shaking sats program with ShakePay. I see a lot of questions with that. I've seen some people bring up that it could be business income, because really, but my take is really it's not a business. You're not putting any time into this. I mean, shake my phone for a second a day. It's really just kind of a gift, for example, that they're giving you. My approach would be to just treat it as I'd receive it, zero cost base for that Bitcoin that I've received. So the fair market value, whatever that day was, would be kind of where I would start. So then when I dispose any of that gain there would be taxable. So yeah, that's something that I don't know how CRA is going to treat that as we get into more of these. Anytime you generally have a gift, yeah, you'd have kind of no cost base to that. So you pay gain on whatever the difference there. Sorry, lots of questions here. One other thing I'll touch on before I'll try and jump into some of these questions is another way that I do see people, or one thing I do see is a lot of the interest. There's different programs that you can, I guess, put in and earn interest on your Bitcoin, whether it's in kind, in separate tokens. I know there's a couple of apps that do that. That would be considered interest income, not capital gains, even if you earn it in kind and they're paying out Bitcoin as whatever an annual percentage. Seems to be pretty common as well. So for that case there, what we'd be really looking at is you pay interest and report whatever the fair market value received was. So if, for example, you got 1 Bitcoin and it was worth $50, that would be interest income, would go on your tax return. You're not going to get any kind of slips for that. And then your cost base for that would be $50. And then if it increased to $100 later on, you'd pay tax capital gains on the difference there. So something that we do see is pretty common. And yeah, so you'd have to kind of separate into 2 transactions, but you'd be paying tax in different ways, because the interest would actually be just taxed 100% at your marginal rate. And then the change between when you've earned it and when you sell it would be a capital gain, unless you're doing so much trading that you'd fall under that business income banner there. Yeah, so
couple of questions here that were on my list. Um, the first one actually, that Bitcoin qualify as property when doing a Section 85 rollover. Um, that one, I wouldn't be able to tell you off the top of my head. You'd have to look at the eligible property rules. One of the things is if it is capital property, it is eligible. So if you are holding it as capital property, it should qualify, but I don't know. I'd have to dive into the Section 85 and go deeper on those and see what criteria we'd be really looking at. Um, because it would likely fall under that section. But if you were rolling it in, yeah, I'm not sure how that would look and the benefits of doing that. But that would be something to I'd have to dive in deeper to answer that question. Um, so tax implications of borrowing against your Bitcoin. So that's an interesting one because yeah, you do have all those different loan sites that you can, you can take collateralized loans against your Bitcoin there. And what I would say is you're not really disposing of your Bitcoin, you're just securing it as collateral for a loan. So essentially, if you receive a loan in normal Canadian dollars or stable coins or whatever, um, that wouldn't be a taxable event there. What you do with that when you receive and you pay back the loan, once again, that wouldn't be a taxable event. It'd be no different than taking out a loan, putting your house up as collateral. You're not deemed to dispose of your house when you do that. If you do get margin called, if something were to happen, then that would be a taxable event then, and you'd have to kind of go through things and figure it out. So as far as just taking the loan, paying it back, you might have to, depending on what kind of currency you take it in, you might have to look at that. But generally, if it's a Canadian dollar stable coin, there's no, it should be a fairly zero transaction. So let me look down here. So question about Mount Gox. So is that considered a separate pool of identical properties? So identical property, we look at it from a individual basis. So I'm not sure exactly what you mean there, Stephen, by that, but they're not, even though they would be holding all the assets, I mean, you'd personally be considered to hold your own. So whatever assets you own would be considered identical properties. You wouldn't really, they wouldn't consider all them that they hold, and it wouldn't change your cost base. Your cost base would be, yeah, boating accident. Your cost base would be whatever property you own. So yeah, a minimum time frame for capital gain loss. So yeah, no, if in Canada, there's no difference. There's no short-term, long-term capital gains. It's all taxed. If it is a capital gain, it's all taxed at. So you take capital gain, 50% is included in income, and it's taxed at your marginal rate. That's just how the capital gains work. It doesn't matter if you're holding it, you're buying, selling every day. Well, even then, we'd have to look at, are you running a business? Is there intent to profit? Are you putting in lots of effort? All those kind of things would factor in. But generally, if you needed to just sell it because you needed cash, or you just you don't want to hold it anymore, that wouldn't be, there's no effect if you had it for, 2-3 days or 2-3 years. So, so is the interest an expense? So generally, expenses are only deductible when they're incurred to earn income. Now, with sometimes with stocks, you can borrow money, buy, a dividend paying stock, and you might, um, perfect. Yeah. You can deduct those as long as you meet those criteria. And some people do that with, home equity line of credits or whatever. But in this case here, crypto wouldn't be considered a dividend paying security, or it wouldn't meet those criteria. So, and generally the only income you'd be expected to earn is capital gain. So that's one of the restrictions against deducting interest. So generally you wouldn't be able to take out a loan, buy more crypto, and then deduct that interest. And if the interest or the loan was taken out to fund personal expenses, then you wouldn't be able to deduct it because that's basically a personal expense. So so capital gains losses only taxed after selling. Yeah, so that's a good one. Buy and hold, nothing there. If you are converting from one crypto to another, that's actually a taxable event. So that's something to be careful for. But if you just buy some Bitcoin, you hold on to it, if you don't sell, you don't convert, it would not be a taxable event. If it's just sitting in your wallet, if you move it to another wallet, well, it would not be a taxable event. However, if you do incur some transaction fees, that's kind of an interesting situation. So I've kind of looked at this. I haven't seen anything specific on it, but I've kind of looked at this as well. You're paying transaction fees generally in Bitcoin when you transfer it. So that would actually be a disposition at whatever the fair market value was on that day of those transaction fees, the amount of the transaction fees. So what you would actually have there is, a small capital gain or loss at that time, whatever the transaction fee was on that transfer. So it's kind of an interesting way to look at it. I mean, practically the numbers likely wouldn't be huge. Just, I mean, I know transaction fees have been up quite a bit lately, but um, it would really depend on, well, I guess that would be how we'd want to treat that. But if you weren't recording that and you were adding it to your cost base, I don't think the government would be too upset, because the dollar values on those are low. And really, I think you'd likely be something that would kind of fly under the radar. And as long as if that's the case, it would probably add to your cost base. But yeah, since we're talking about, usually, I mean, the fees I've seen, again, $30 sometimes. I mean, I know some of the other Uniswap fees and stuff like that can get pretty high, but at the moment, I think for Bitcoin and stuff like that, it would be a pretty small thing. So if the government were to ever throw the hammer down at you on that one, it would be a pretty small effect. What they're more concerned about, and I'll talk about that a little bit later, is definitely the people that are using it to avoid paying tax and just not reporting anything. So that's a big thing to consider in this situation here. Is really the small things, it's not gonna be a huge negative effect on that. It's the big ones. If you're selling, pulling money out and never paying tax on it, well, those are the guys that they're going to go after. So um, there's an interesting one. Yeah. Boating accident. I mean, that's kind of a question. If you lose your wallet and no access to it, yes, the government can't tax you on that, but it would probably be up to you to prove that you can't get at it. And so I don't know what even that would look like. I guess you never disposed of it. If it's sitting on a wallet there and you've never disposed of it, well, you don't have a taxable event. The government might come looking if they see that you do have, you've got a wallet full of this stuff. But that being said, I guess I'll touch on this now. I know that some of the exchanges have started providing information to CRA, IRS, stuff like that. And I think that as we get future, or as we go forward and as it becomes more popular, I'm pretty sure, there's very few sites now that don't have, or exchanges that don't have some sort of know your customer ID process. So yeah, the government might not have the information now, but they're going to get it. And what it'll likely look like is a list of transactions by person, and they'll probably go through, flag, look for big ones, look for big sells, and then they would look and compare it to your tax return, see what you've reported. So, if you are always just buying, transferring off an exchange, that might not be as big of a flag. The big thing that I think the government will start coming after first is those buys and sells on the exchange where they have the information, because that's going to be the low picking fruit. So they'll probably, I have a feeling the next 5 years they're going to start getting a lot of information from those exchanges. Data analytics these days is pretty impressive. So it's not too hard for them to look at transactions, compare it to your tax return, and see if there's something that they think is missing. And then they send you a letter and ask for more information, which is not always a good time. But yeah, so let's see here. Okay, so superficial loss rules. So that's kind of an interesting situation where you've got like you're buying and selling. So the way that works, superficial losses are if you acquire an identical property 30 days before or after a disposition. So essentially what it prevents is someone selling for a big loss and then rebuying the next day for, I guess a lower, or sorry, claiming a big loss and then rebuying at a lower cost base and deferring kind of a capital gain later, or using that capital loss to offset maybe other capital gains. So That would only apply when there's a loss, but it would apply if you were to sell and then rebuy within 30 days, or if you were to, buy some within 30 days before the disposition, then sell to trigger that loss. And what happens there is basically that loss gets added to the cost base of your other investment, and it essentially kind of nils the transaction. So you'd still report a transaction, but you wouldn't actually have a gain. You wouldn't have a loss that you'd claim, and then your cost base would get increased. So you're really in the same kind of spot in the end there. So, but are the coins in GOX averaged in price? Also, we will get distributions in future, so maybe average would change when received. So in that case, so if you did have coins there that were lost, and then they, everything kind of comes out and they're able to pay out a distribution, you'd likely want to, if you're actually receiving coins back, well, then I would say, if you say you had 100 coins there and you received 50 back, your cost base would just flow into those 50 shares, and then you'd report a disposition of 50 for zero. And you could likely claim a loss. I'm sure there'd be enough information out there that would support that. But essentially, what you are is you're disposing your Bitcoin for zero, for whatever you don't receive back. Now, if you were to receive just a cash settlement, you'd take the whole amount of Bitcoin, whatever your cost was, and then take the cash. That would be your settlement amount, and you'd have either a gain or loss, however it worked out. So the ones, whatever you held personally would be the ones being averaged. So you would have to treat whatever you receive from it. If you receive nothing, then essentially you could probably write it all off. It would be up to you to prove that. I know that at a certain dollar value, they start looking at capital losses, and especially when you've got capital gains to offset them, and then you'd have to just prove that you can't get them. I know with some of the more prominent issues, it's probably a little bit easier to prove that, and especially with the way you can kind of track Bitcoin, I'm sure you'd be able to, show your wallet addresses and how money had gone in there, and then, with the history, you could probably prove that you're not getting that money back. And if you ever did at some point in the future, then at that point, you'd have to report some sort of capital gain or something, some sort of income on your return based on how that worked out. Yeah. So what if you buy for someone else? So if you were to buy it for someone else, prove a gift. Yeah. So really in that case there, it wouldn't really, if you bought it and then sent it to someone else, you would have to technically report a disposition when you do send it to them at fair market value. So if you bought it, it was $10 on Friday, send it over on Saturday, it's up to $11. You'd have a $1 gain there. Depending on the change in value, you'd want to report it. I would report at least something, some sort of disposition, just to show that, I did trade it to them. If you did mean to buy them $10 worth and then it went up to 11, well, you might have to pay tax on that $1 change. But depending on how quickly it happens, that would be kind of if it was the same day, I probably wouldn't report anything, even if it changed a little bit, just because I'm sure the government will be fine with average pricing for now, just because it is so hard to actually pinpoint exactly what price something was at the time that it sent, because every day it seems to change up and down. 5% isn't that big of a swing. So to find the exact value at the time that you sent it, it's quite a bit of work, and they don't expect you to be that detailed, just as long as you make a reasonable effort. So when I sell from my current pool, okay, so I need to consider coins locked into GOX right now. So yeah, that's what would happen if say you had two pools and each one had, let's just, for easy numbers, each one had 100 Bitcoin in it, and half were locked away in GOX, and your total cost for those was $200. It was $1 Bitcoin. Well, if you were to sell all the ones you hold outside there, you would basically have, $1 a Bitcoin cost, and you would get rid of those at, the average cost of your Bitcoin. And then when whatever resolves for Mount Gox, then at that time you would treat the rest of those. So when it's determined that nothing's being recovered, it's determined that some's being recovered, that's at the point that you would likely you deal with the rest of those. So I'm not sure exactly where the situation lands on that, but I'm sure eventually you could likely claim that they're lost. But the downside of that is if you ever do get anything back, then you'd have to pay tax on that at that time. So yeah, so I'm talking
On
a
the
lot.
can I follow up on that small transactions thing you were talking about there? Because that was another question I had where like I've done a lot of just testing, you know, with a few bucks here and there to try a different exchange or trying different wallets and sending little things around. And one of the things I've been worried about is like it's way more of a pain if I was trying to tally up all those tiny little things rather than the ones that are actually, I would say, have significant like tax implications. So would they ever use that against me at some point? Like there's a bunch of transactions, but they're so tiny it doesn't matter.
Well, I mean, you gotta. I think of it this way. So, really, they're not out there to nickel and dime you as much as sometimes it feels like that. Um, if you've got transactions where you're moving stuff around, you're testing. What I would probably do is I would just record it as I would just add that to the cost base of them personally. That's what I would do. Technically, that's not correct, but when the dollar values are small, is it really going to matter? They're not going to come back and ding you for $5 more of tax. That's just not what they're looking for. And most of the time, if they did come back and it was a small amount, they were not going to be concerned. They're not going to throw the book at you for that and say, you know what, oh, you should have paid $5. You should have reported this. It's not going to be that. They're looking for, especially as they get a little bit more focused on this kind of stuff, they'll be looking for big dollar values. They'll be looking for that kind of stuff. And so I'd say you'd be pretty safe not really reporting those, but just keep in mind that technically you probably should. So it's
Right.
all risk management at that point.
Okay, and just the other thing that you mentioned, which was I'm not totally clear on the within 30 days thing, but like just in this scenario, if let's say you wanted to trade one thing for another, but you had to go through another asset first, like on an exchange, you needed to change tether to dollars, but you couldn't directly sell it, so you had to go through exchanging it for Bitcoin and then dollars. But the purpose wasn't buying and selling the Bitcoin; it was a instant kind of just swap. Does that have to be recorded, and is that taxable if you bought Bitcoin before at lower prices, even though you weren't profiting off it there?
So if you were trying to say, yeah, get it to, from A to C, and you had to go through B, well, it's going to be any exchange from one to another, even if it's a stable coin, anything like that is going to be a taxable transaction. Now, you'd have one on your, for example, if you had a big gain, accrued gain on your Bitcoin and you're transferring it to say Tether or something like that, that's where your taxable transaction would be. And then you technically have another one, but if it's all happening pretty instant, once again, there probably isn't a ton of change in value between when you buy the Tether and when you buy the next one. Now, if there is, I would report it. If not, once again, the government tends to look at these things on a kind of a bigger scale. So if there's really not a huge change, you're gonna, personally, I think it would be a lot of extra work to record all those little ones. You could probably skip the middleman and just go one to the other. But the important one would be to show, yeah, I had this gain on my Bitcoin. I transferred it to Tether, and then I bought, something else with it. Paid gain on that, or I reported the transfer to the Tether, or even all the way through to whatever the other one was. You could probably skip Tether. What they're really going to be looking at is, was something reported and was there a gain paid? And I think that's kind of the main thing there. They tend not to dive too much right into the little details and worry about the pennies. That being said, each transaction technically is taxable. So if you wanted to be perfect, you'd record, all the way to Tether, and then all exchange into, whatever you want, Monero or something. So yeah, and with those 30 days, that only applies to the identical properties. So if you were to say sell, and only when you have a loss, and the idea behind that is to prevent you from trying to realize losses and then rebuy the asset so that you can lock it up at, you still have the same amount of Bitcoin, but really you just claimed a big capital loss because it had gone down in value. right? And that the idea there is they don't want you loss farming like that, and especially if you're not actually disposing of the asset. So another thing that I find kind of interesting and is still coming out. So with foreign reporting rules, there's T1135 is the form that technically needs to be filed if you have more than $100,000 cost in specified foreign property. Now, from what I've kind of read on CRA's interpretation is that if any crypto is held on a foreign exchange, it would be considered specified foreign property. Now, if you held it in your own wallet at home, I don't think so, but I don't know where they're going to land on that kind of stuff. But if it's all sitting on, Binance, for example, I'm pretty sure they're not a Canadian exchange. I don't think you could make that argument very well. And so they would want you to actually report that. And where that comes into place as well, it doesn't matter if you didn't buy 100,000 worth, well, if you bought it at $1, it was worth 100,000, and then you converted it into any other crypto, well, then now your cost base for your new crypto is actually going to be over 100, and you're going to need to start reporting that. So it's kind of something that, well, the problem with it, there's no tax on these forms, but there are penalties if you don't file it. I have no idea when the government would get to actually being able to look into and finding out those details, but if you are holding a significant amount with a cost over 100 grand on a foreign exchange, you probably would be better off reporting it. Now, I don't know what, a ShakePay, a Newton, some of the Canadian ones, I think CoinSmart, I don't know. There's some of the ones, the Canadian, I don't know if you could make an argument and say, okay, well, it's in Canada, so it's still in Canada. But that's kind of something that I think is still being fleshed out over the next little while. So I would probably, if you wanted to err on the side of caution, I would file that if you do have a cost over 100,000. So it's not fair value, it's cost. So if you bought early and then you exchanged it at some point, and so now your cost has been bumped up because you had to report a capital gain at that time, and then your capital gain kind of becomes your new cost, or the fair market value of the new asset becomes that cost, then I would look into that. So once again, that's kind of on a, but if you were to buy and you just held, then at this point, unless you spent more than 100,000, it wouldn't be a concern for you. So per asset, no, it's a combined, $100,000 cost is combined asset. So where that actually becomes really interesting is if you were to hold $100,000 in Apple shares, or a cost of $100,000 in Apple shares, well, that's a specified foreign property because they're not a Canadian company. Now, once you hit that limit, you actually have to report all of your specified foreign property. So if you had, Bitcoin with a cost of $5 sitting, on a foreign exchange, well, you'd actually technically need to include that on the form as well. And then you'd also have to look into, okay, well, do you have cash accounts, and do you have a US dollar account from Bank of America or something like that? Every foreign property would have to be reported, and it's the combined cost base of all of your foreign property. So foreign property it's a pretty loose term. I would suggest Googling specified foreign property if you think that applies to you. Look through the list. It's only on income earning stuff. So if you had a vacation house down in Florida, that's not it. Unless you start renting it, then that would apply. So kind of a little tangent there, but something to consider if your cost base is that high. So
Are you saying that only matters if we're getting interest on the Bitcoin, or it's considered income earning on its own?
It would be considered income earning on its own. It's same with it'd be same as a stock or something that doesn't pay dividends, isn't expected to pay dividends. Well, it'd still be specified foreign property. It is considered an income property. So
okay, and you're not sure how they're going to treat our own hardware wallets or something like MetaMask that just kind of lives online. It doesn't really live anywhere.
Yeah, so I would make the argument that if it's something that, if it lives online and it's because so the official position that they came out with was that if it's on a foreign exchange, then it can be considered to be a specified foreign property. So now, if you bought it on a foreign exchange and transferred it to your own wallet, well, technically it would have been on a foreign exchange. Just for part of the year, you'd still need to file it. but if it's on your own wallet, if it's in Canada, then I mean, I don't know. I think they'll have a little bit more guidance on that as they go forward. But for now, I'd suggest sticking with if it's on a foreign exchange or if it's in. So now if you've transferred it to, I think, there's a few of the I don't know where, so Celsius is one, Nexo, I know BlockFi, I don't think any of those are Canadian companies. So those would be considered foreign held as well. In that case, you don't own your keys well, I'm not sure about all three of them, but I'm pretty sure with Celsius, you don't own your own keys there. They hold it on your behalf. So you'd have a specified foreign property in the asset that they hold for you in a foreign country. So.
And if it's decentralized like Uniswap, it's not really located anywhere, right? But is that just foreign for everybody?
So yeah, once again, it's kind of I can't give you the exact answer for that. I would say if it's something that you own, if you've got the keys and the keys are on your computer, well, I guess they kind of just exist, but if they're on your wallet or whatever, they're at your house, I think you could make an argument that it's here, it's mine, it's in Canada. But that being said, is they kind of have to get there somewhere, and at some point it would probably run through this. But yeah, I don't have a 100% answer for that. I would say if you want to be more safe than sorry, you'd report it. But I know everyone hates giving the government more information than they really need, so that's kind of a tough one. Yeah, I can't give you a good answer on that. I would say I think CRA put up a little bit of a blurb on that, but mostly just touching on the exchanges and or kind of holding services that might hold your assets. So.
I've got a related question to the giving governments more information than you need to. Has there been much talk around how the CRA or the government will treat things like coin mixing and different privacy preserving tools within Bitcoin?
Not that I know of. I think so. What the government actually gets when you file your tax return and you file a Schedule 3, which is where the capital gains will go, they just get a number. They just get bottom line. They don't get all the details. If you put up a big list, they're not going to get. If they want more information, they'll ask you for a copy of it. So I think, I mean, personally, if I was a CRA auditor, my first approach would be to get the kind of the information from the exchanges that are going to provide it, go through, compare that to tax returns. If I see stuff reported on that tax return that looks like it's, I can see a buy on this exchange and a sell and things look like they line up, you're probably pretty good. And I don't think more details would be needed. I mean, it's pretty common practice if I'm dealing with a portfolio or something and someone's disposed of stuff, I summarize. I don't give all the details unless they really want it. So that kind of extending to some privacy, to some of those kind of things there. I think if you were to report it and pay tax on it, I think they don't care. They're not gonna be upset that you're not giving them more details. They might want to look into and make sure where you got your stuff from. And if you can prove it without giving them more information than they need, then you'd be good. But really, it just comes down to the dollars for them. I don't think they really care about anything else than, did you make some money off this? And then did you pay your tax for it? So.
On that distinction you made between the capital gains and operating a business, I've read that there's certain, and you alluded to it, that there's certain things they use to define one or the other. And one of the things I think is, did you purchase with a loan? So if you had a loan and you used that to buy crypto, it went up a bunch and you sold it, that might be a reason they looked at that as a business venture as opposed to capital gains. Is that correct?
So that's something to consider. I would say, it would be no different if I go out and take a loan against my house and buy a bunch of TD stock. I'm not buying it because I'm trying to day trade. I just think that it's an investment that's going to increase in value, and I'm just leveraging myself. So I would say if that was the sole consideration, it would be an easy one to kind of get out of the business income, and it would be on account of capital. the other things that they look at, frequency of transactions is a big one. The type of the property. So, you know, with crypto, it tends to be something that people kind of, you know, you can kind of get lumped into two categories. There's kind of buys and holds, and then there's definitely very obvious kind of trading. So really, it would kind of come down to a few things: how long you're holding it, you know, frequency of transactions, the type of asset, you know, what your intentions are. Which, I mean, that's a small factor, but I mean, if you open it up, try to trade, lose a bunch of money, and then you buy some the next week and say, you know what, I'm sitting on this and holding it. Well, I don't think you'll get punished for that second set of purchase once you realize, you know, I just lost a bunch of money trying to trade. Now I'm going to invest, you know, and hold on long term. So it's really fact specific, but one of the other things is the amount of time that you put in, also your experience with it. So if you know, if you were developing your own crypto and then you're also buying and selling frequently, you're also doing all this kind of stuff, then there would be more of an argument that, yeah, you're kind of in the business of this. You know, and so there's a lot of things that come into play, but yeah, I don't think just getting a loan wouldn't be a determining factor unless everything else kind of was playing in as well.
Yeah, I've heard a lot though. That just makes it very confusing. Where I'm pretty sure it's capital gains, but then the way they word it sometimes, or even sites that summarize it, is like if your intention is to sell it later for profit, and it's like, well, come on, that's what everybody's doing for capital gains. I mean, you make investments to make money, and so it's just strange the way they word it sometimes. That if your intention is to sell it later for a profit, then it's a business, but that's not. It can't be that.
Yeah. I mean, yeah, I like to use the same kind of analogy back to stocks a lot of the time. You know, if I'm buying stuff to sell later for profit, it's not. Now, if I'm buying and selling over and over again, if I'm putting lots of time into this, I'm spending every day kind of researching trends and buying and selling lots. I'm buying highly, you know, I'm looking for the very volatile stuff so I can buy and sell and make little, you know, then you could argue, but you could argue maybe it is a business, but length of holding is a big consideration. So it's really hard to argue if you buy something and hold it for 2 years that you were actually buying it as a business and inventory, and that was part of your, you know, your business plan was just to hold these things. And it'd be very hard for them to make that argument. And generally, it kind of, you know, if you're buying, holding, and selling, and you're not making many transactions, and there's not a limit, but if you're making even a transaction a day is not a lot, especially if unless you're, you know, buying and selling every single day. Even then, you know, there'd probably be other factors at play that would have to come in and determine whether it really is a business. So one of the things I see sometimes too is when they look at day trading is, you know, do you have a full-time job? Because if you got a full-time job, you know, working in a restaurant and you go to work every day, well, are you really sitting down and operating a business and day trading? You know, if you come and you place a couple of trades on your phone during lunch, or, you know, is that really a business? Probably not. You know, are you sitting at home all day, you have no other source of income, you're buying and selling, you're cashing in to pay your expenses? Well, then maybe that is a business. So a couple of things to kind of consider there.
Right. Yeah, I don't really understand the research one. I've heard that as well before, and it's like if you're going to make an investment, you're probably going to research it. You know.
Yeah.
So, yeah. Anyways.
So yeah, it's a tough one, and it's case by case, and really, you know, I think for me, the thing I always look for is how much effort are you really putting in? And I mean, you can say that, you know, doing a lot of research on different crypto, Bitcoin, all that kind of stuff, looking at trends, you know, it does take some time, but, you know, I don't know, a lot of businesses take hours a day, 8 hours a day, 5 days a week. Are you doing that? Then in that case, you know, yeah, it might be a business, you know, or is it just a hobby? So that's something else that kind of come into play. Is it just something you're really passionate about?